and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on natural gas, and my guest is Wayne Bryan, Director of European Gas Research at Refinitiv. The Russian invasion of Ukraine has triggered an overhaul of energy priorities around the world, especially in Europe, where Russia supplies 40% of the EU's natural gas, raising fears of a big freeze without Russian supply. This is the ICE Natural Gas Monthly Energy Future. It spiked, as you can see there, on Monday at over €220 a megawatt. That's $242 when Russia warned on Monday Western sanctions could prompt it to cut the major gas pipeline to Europe. That's 10 times the price at the start of the pandemic. The EU hasn't followed the US in banning Russian gas imports, and supply has yet to be disrupted by the crisis. But the bloc has announced a plan to cut dependency on Russian gas by 2/3 this year and end its reliance on Russian gas, according to plans, at least by 2030. EU gas storage is currently only 27% full. That's enough to last out this winter, even without Russian supplies. But the EU is set to propose countries must fill their reserves to 90% by October 1st to keep the heating on over the winter. The bloc also plans to reduce demand by switching to clean energy.
With the plan we outlined today, the EU can end its dependence on Russian gas and repower Europe. Fit for 55, once implemented, will reduce the EU's total gas consumption by 30% by 2030. That is 100 billion cubic metres of gas we will no longer need.
For more on this, I'm now joined by Wayne Bryan, Director of European Gas Research at Refinitiv. Wayne, hi. Is this feasible for the EU to replace Russian supply in the medium term?
In the medium term, yes. It's going to take several years to actually do this, but in the short term, certainly not. What we see in terms of Russian exports of gas, it accounts to about 35% of total gas imports into the EU. Now, to try and replace that in the short term is going to prove very difficult. Norway's running at capacity. We're seeing US LNG utilisation and exports running at capacity. So we don't really have many real options in the short term. If we take this further down the road, then yes, some of the measures the EU are proposing can help us wean our reliance off Russian molecules. And I think that can take up to the next 5, 6, 7 years, as they're actually proposing at the moment. We're all obviously waiting for the final ruling on this. But I think, yes, we can wean ourselves off this Russian gas, but it's going to take some years. And I see a lot of reports saying, cut the taps off now, let's stop taking Russia. That's not feasible, let's be honest. We can't do that at the moment due to the over-reliance of Russian gas that we currently have in Europe.
In the short term, then, how high can this price pressure go? What if Russia follows through on that threat to cut off the main pipeline?
Well, it bears thinking about. It doesn't bear thinking about, really. I mean, what we saw on Monday, I mentioned, were record prices across TTF and NBP on several of the several of the contracts. If we were to see a cut of Russian flows, even if it was just for a 1 day, Monday's price would look seriously cheap and look to be rock bottom compared to where it can go. And it can go very high. We saw that intraday with an 800 pence per therm trade on NBP. So I think we'd be going way past that.
Which companies are most impacted by this? What does it mean for utilities and for companies that are big consumers of natural gas?
It means a lot. And in terms of utilities, I mean, for example, we've seen quite a few smaller energy companies. I think the biggest one was CNG in the UK that collapsed due to the wholesale market and the sort of crazy moves we've been seeing. So it's having a huge impact on these suppliers, especially when it comes to hedging, maybe buying future consumption for its domestic portfolios. In terms of manufacturing, it's affecting a whole lot of industries. We have a lot of energy-intensive industries, glass making, ceramics, chemicals, etc. These now, the prices here are rising so much for some of them, it makes case to turn off production. And we've seen that today with the announcement from Yara, which is a very big fertiliser producer. They've announced they're cutting production by 45%. So we're already seeing demand destruction start to kick in. And actually, we foresee more of that coming over the coming months if prices stay at elevated levels.
This energy crunch has led some producers, especially in the US, to say they want to extract more gas. Obviously, a few months ago, that would have been an unfashionable investment. The focus has been on switching to clean energy. But do you think that this will change the energy markets in the medium term and prompt investment to go back into fossil fuels?
I think what we're seeing now is a reconfiguration of the energy transition. And I don't mean that by we're going to give up on that, because it's still something everyone wants to achieve. But when you look at what's happening now, I think it needs to slightly take a backseat in the short term while we try and wean ourselves off Russian molecules. Now, as I mentioned again, it's not only the gas, it's 46% of EU's coal comes from Russia, and 25% of oil. So there's a whole raft of commodities that we import. So to try and say, look, because of the energy transition, we're not going to go down this road, I think that would be remiss. And we see the situation, how it's developing in Ukraine, and I think if that further develops in a negative way, then perhaps we're going to see even stronger, more draconian measures taken by European markets.
What does it mean then for the retail investor?
Uncertainty, prevailing uncertainty. As I mentioned, we've never seen volatility like it. We've seen, we've had some volatile periods in the European gas markets. 2018 comes to mind, the beast from the east, concerns around Nord Stream 2 at the end of last year. We've had problems obviously this year running up to before the actual invasion started. So that is going to continue. And I mean, where did you get in? Where did you invest? What time did you invest? You could now be losing, you could now be on a winning streak. So it's just a case of uncertainty is going to drive that. And of course, we're seeing even speculators get involved in the market, driving volatility up even more. So for an investment side of it, or retail investment, it's very, very concerning times really, but due to the volatility.
Thanks so much for that insight, Wayne Bryan, Director of European Gas Research at Refinitiv. Well, before I go, let's take a look at some of the top stories in this sector. Shell said on Thursday it faces a $400 million write-down on its Russian downstream assets after announcing it would quit all its ventures with Gazprom and related entities, including the flagship Sakhalin-2 LNG plant and the Nord Stream 2 pipeline project. That's on top of $3 billion mentioned in the announcement last week. The exodus from Russia has been expensive for some energy companies. BP is facing a $25 billion write-down on its Russian assets. Oil prices have bounced again this Thursday after the UAE backtracked on earlier statements, saying it would be willing to pump more oil to fill the gap left by Russian crude. The country now says it will stick to OPEC Plus targets to raise production gradually. Among OPEC Plus producers, only the UAE and Saudi Arabia have much spare capacity that they might be able to bring online. And energy executives gathered at the CERAWeek conference in Houston have used the energy crunch to argue the case that US gas producers should bring more supplies to market. The head of the largest US natural gas producer, EQT Corp, said the US should quadruple its gas export processing capacity to 55 billion cubic feet per day to help end Russia's grip on Europe's energy supply. Environmentalists say the high prices highlight the need to accelerate the switch to renewables, and they reject industry attempts to frame natural gas as a greener fuel. And that's your roundup of the natural gas sector. I'm Elena Casas, and this is Reuters.